This course is one in a series of courses offered by Career Physician to provide you with valuable knowledge and skills that will give you an edge as you begin your professional career as a physician. One of the biggest decisions you'll make as you complete your medical training is likely going to be joining a medical practice. If you're like most medical students, however, you're probably not prepared to effectively distinguish an outstanding opportunity from a mediocre or even an undesirable one. There are a number of subjective or personal factors that only you can evaluate, such as geographical location or practice size. However, when it comes to understanding exactly how you'll be compensated, it's critical that you thoroughly understand the different factors that contribute to a particular practice's method of compensating its physicians. Many medical practices use a productivity-based or incentive-based compensation plan. In other words, your compensation as a physician will be based on your productivity in the practice. This course will describe 3 different types of productivity-based compensation plans and why they might be appropriate in different types of practice settings. It will also provide you with a conceptual introduction to productivity-based plans, methods of evaluating productivity-based plans, methods of identifying and measuring the financial drivers in productivity-based plans, and relationships between productivity-based plans and the practice's income statement and practice management system reports. While it's not essential, it would be helpful if you've already completed the Career Physician course, Assessing a Practice's Financial Condition, prior to beginning this course. Once you've completed this course, you should be able to understand common terms used in productivity-based compensation plans, identify key financial and practice management reports that are used in measuring compensation, understand the equations behind the calculations, identify key information from the practice's financial and management reports, develop skill in performing the calculations used in productivity-based plans, and combine these concepts and skills to understand exactly how a particular productivity-based compensation plan will affect you as you make the crucial decision as to whether to join a medical practice. Why is it important to take the time to understand what makes up your compensation plan? Well, if you're interested in maximizing your financial opportunities as a physician, you need to know most medical groups use some measure of your productivity as a physician in calculating your compensation. Most medical groups consider practice expenses in calculating physician compensation, and often the assignment of expenses is related to physician productivity. And finally, disputes over compensation are a common cause of medical group practice conflicts. Once you're confident that you understand how your productivity will be measured and how it will be used in a particular compensation plan, you can make an intelligent and informed decision about whether joining a particular medical practice is the right choice for you. Taking the time to understand the relationship between productivity and compensation can significantly improve your income, your relationship with a medical group, and your overall career satisfaction. First, let's define the terms that you'll encounter in learning about compensation plans. These include physician productivity, gross charges, net revenues, net collections, patient encounters, and work relative value units, or RVUs. We'll explain each of these. Physician productivity is a measure of physician work or output. Most physician compensation plans use some form of productivity in determining compensation because productivity measures are generally reliable and consistent. Commonly used measures of productivity include gross charges, net revenues or net collections, patient encounters, and work relative value unit, RVU, production. These measures of productivity are commonly used for clinical activities, but some compensation plans may also incorporate productivity measures for non-clinical activities, such as referred technical services within the group practice. Gross charges reflect the total services billed by the practice at the fee schedule rate before any adjustments are made. Gross charges are easily obtained from practice management reports. The use of gross charges within an organization is a reliable and consistent measure of productivity. However, it's not useful in benchmarking with other practices because significant variations in fee schedules exist across different practice settings. Net revenues reflect the total services billed if the practice uses an accrual basis of accounting, or the total dollars actually collected if the practice uses a cash basis of accounting over a given period of time after any adjustments such as contractual allowances have been made. As a productivity measure, net revenues is easily obtained and is a reliable and consistent measure. However, it's significantly affected by what's known as the payer mix, which we'll discuss later in this course. In addition, the use of net collections as a productivity measure is influenced by how well or how poorly the business office side of the practice is performing in collecting monies owed to the practice. Patient encounters are occasionally used as a measure of productivity. For example, tracking the number of office visits for each physician in a given period of time. However, patient encounters may not be a useful measure in certain specialties with significant procedures or surgeries. This method also does not factor patient acuity into consideration. A Work Relative Value Unit, or RVU, is a number assigned to a particular service that establishes the amount of work necessary for that service to be performed relative to another service. Each current procedural terminology, CPT code, is assigned a work RVU. One advantage of using RVUs is that it eliminates some of the problems associated with using gross charges or net revenues as productivity measures. The use of RVUs as a valid productivity measure relies heavily on accurate CPT coding for services provided by the physician. One disadvantage for a group in using RVUs is that it may not align financial incentives with other group members. Here's the basic equation that you'll use to analyze your potential compensation as a member of a particular medical practice. Start with your likely gross charges, then subtract contractual allowances, bad debt, and write-offs. This will give you your net revenue. Then, subtract your direct expenses and your indirect or shared expenses, or your share of the practice total expenses. This figure will equal the income available for your compensation as a physician. In other words, net income is the difference between net revenue and expenses and is generally the amount available for physician income. Let's look at the details of this equation. First, we'll look at practice expenses and the different ways in which they can be handled. One of the most significant aspects of a productivity-based compensation plan is the way it treats practice expenses on the individual physician level. This area alone can drastically affect the amount of income credited to you as an individual physician for compensation. The way a particular group accounts for practice expenses or practice overhead on an individual physician basis is often a reflection of the group's philosophy. Some groups believe that most practice expenses should be shared equally by all physicians in the group. The philosophy behind this method could be summed up like this. We are all responsible for the expenses of this practice. If you choose to work more than the average physician in this group, you'll be rewarded because your portion of the total expenses as a percentage of your revenues will be less than that of the other physicians. If you choose to work less than the average physician in this group, you'll be penalized because your portion of the total expenses as a percentage of your revenues will be greater than that of the other physicians. This method or philosophy of allocating total practice expenses equally actually works quite well if all the physicians in the group work and generate revenue on a fairly equal basis. However, it doesn't work well if some physicians are working significantly less or generating significantly less revenue than the other physicians in the group, or if the practice includes a new physician just starting his or her practice. The underproducing physician, part-timer, or new physician sooner or later will say, "Hey, I don't use the office space or staff as much as you do, so why should I have to pay an equal share of the expenses?" If an equal sharing of expenses does not fit a group's needs, how else can expenses be shared equitably among the physicians in a group? One way is to measure physician productivity based on total expenses generated by each physician. The philosophy could be expressed as follows. Physicians who are more productive consume more practice resources in our group, and they generate more expenses than less productive physicians. Therefore, those physicians should be responsible for a greater portion of the total expenses of the group. As a result, many compensation plans allocate practice expenses to individual physicians based on the same measures used to measure that physician's productivity, such as that individual physician's gross charges or net revenues or net collections. Another method distinguishes between expenses that can be directly attributable to an individual physician, direct expenses, and expenses that affect the practice as a whole, indirect expenses. Under a compensation plan based on this method, all individually identifiable expenses, direct expenses, would be charged to each individual physician responsible for the expense. Then, the remaining group expenses, indirect expenses, would be allocated among the group members according to a formula based on individual physician gross charges or net revenues or net collections. This modified method recognizes that some physicians may choose to incur greater expenses than other physicians in the group, such as in levels of health, life, dental, disability insurance coverage, and that they should bear the cost. At the same time, it recognizes that many expense items, such as office rent, should be shared equally because office space must be available for every physician, whether that physician chooses to use it fully or not. While both the expense allocation method and the direct and indirect allocation method work very well in many groups, they too can create friction between group members when there's a great variance in physician productivity. High producers begin to question why they have to continually bear greater and greater portions of the group's expenses as they work harder and harder, eventually far exceeding the productivity of other physicians in the group. The high producer begins to feel as though he or she is carrying the group and that the others are getting a free ride. In practice, there's some truth in this concern. Productivity-based compensation plans, as with all compensation plans, should provide an incentive for the behavior that's desired by the organization. When one physician's portion of the group's expenses greatly exceeds that of the other physicians, it may begin to have a negative impact on the high-performing physician. At some point, use of this method begins to create an inequitable allocation of the group's expenses, many of which are fixed expenses that do not in fact increase much with the increased productivity on the part of an individual physician. In such a situation, setting a floor of expenses that all physicians must be responsible for and a ceiling of expenses that top producers will not be charged more than may result in a more equitable compensation plan. The key feature you should look for in a productivity-based compensation plan is that it creates the behavioral incentives valued by the group and that it's viewed as equitable by the group members. All compensation plans can be adjusted to fit the specific needs of a group, but there must be agreement on what those needs are and how fairness will be defined. As we've just seen, there are a number of different combinations of productivity measures and expense allocation methods that can be used in productivity-based compensation plans. Your income as a physician can vary widely depending on how the compensation plan is structured. Let's take a typical three-physician practice owned by Dr. White, Dr. Brown, and Dr. Green. We'll do the math using three different compensation plans and see how each doctor fares in the different plans. To keep things simple, we'll use the same basic numbers in each one of these scenarios. We'll assume that the total gross charges for the practice equals $3 million, of which Dr. White is responsible for $1,200,000, Dr. Brown for $980,000, and Dr. Green for $820,000. We'll also use the same figures for contractual adjustments in each of the three scenarios. The practice as a whole has $1,385,000 in contractual adjustments, of which Dr. White has $600,000, Dr. Brown has $539,000, and Dr. Green has $246,000. When we subtract the contractual adjustment from the gross charges, we're left with the net revenue. In each of the following scenarios, the total net revenue for the practice is $1,615,000. For Dr. White, the net revenue is $600,000. For Dr. Brown, the net revenue is $441,000. And for Dr. Green, the net revenue is $570,000. For each of these scenarios, we'll also assume that the total practice expenses equals $860,000. So, if we subtract that number, $860,000, from the practice's total net revenue of $1,615,000, we find that the group's net income is $755,000. This is the total amount of money that is available for compensation of the three physicians in the practice. The big question is, how to divide that among the three physicians. Now we'll take a closer look at how each of the three physicians' compensation changes depending on which method is used in the calculations. In the first example, we'll look at the levels of compensation for each physician based on an equal sharing of the practice's expenses. Even though the three physicians in our practice have widely differing gross charges, in this model, they'll each be allocated 1/3 of the group's total expenses of $860,000. In other words, each of them will be responsible for $286,667 to cover the practice's expenses. Our first physician, Dr. White, bills $1,200,000 in gross charges during a year. After contractual allowances of $600,000 are subtracted from that amount, Dr. White's net revenue is $600,000. Using the equal expense sharing model, we'll subtract another $286,667 from Dr. White's net revenue. This leaves Dr. White with an income of $313,333. Our second physician, Dr. Brown, bills $980,000 in gross charges during a year. After contractual allowances of $539,000 are subtracted from that amount, Dr. Brown's net revenue is $441,000. Using the equal sharing model, we'll subtract another $286,667 from Dr. Brown's net revenue. This leaves Dr. Brown with an income of $154,333. Our third physician, Dr. Green, bills $820,000 in gross charges during a year. After contractual allowances of $246,000 are subtracted from that amount, Dr. Green's net revenue is $574,000. Using the equal sharing model, we'll subtract another $286,667 from Dr. Green's net revenue. This leaves Dr. Green with an income of $287,333. In the second example, we'll demonstrate how an individual's compensation can change when expenses are allocated differently. In this plan, each physician is assigned a percentage value based on their share of the practice's net revenue. As we know, the total practice net revenue is $1,615,000. Dr. White, whose net revenue was $600,000, was responsible for 37.2% of that amount. Dr. Brown, whose net revenue was $441,000, was responsible for 27.3%. Dr. Green, whose net revenue was $574,000, accounted for 36% of the total net revenue of the practice. We then use these percentages to determine how much of the practice's expenses will be allocated to each physician, which in turn directly affects the personal income of each of them. Again, we already know that the total practice expenses equals $860,000. Dr. White is allocated 37.2% of this amount, or $319,505. When this amount is subtracted from his net revenues, his income will be $280,495. Dr. Brown is allocated 27.3% of this amount, or $234,836. When this amount is subtracted from her net revenues, her income will be $206,164. Dr. Green is allocated 36% of this amount, or $305,659. When this amount is subtracted from his net revenues, his income will be $268,341. As you can see, by using this method, Dr. White's income has dropped dramatically, while Dr. Brown's has significantly increased. It's likely that without a clear understanding of the rationale for the expense allocation, Dr. White, who has billed the highest gross charges, may not be pleased with this plan. In the final example, each physician is assigned a percentage value based on their share of the practice's gross charges, before any contractual adjustments are taken into account. Remember that total practice gross charges equals $3 million. Dr. White, whose gross charges equaled $1,200,000, was responsible for 40% of that amount. Dr. Brown, whose gross charges amounted to $980,000, was responsible for 32.7%. Dr. Green, whose gross charges equaled $820,000, accounted for 27.3% of all the total gross charges of the practice. We then use these percentages of gross charges to determine how much of the practice's expenses will be allocated to each physician, which in turn directly affects the personal income of each of them. Again, we already know that the total practice expenses equals $860,000. Dr. White is allocated 40% of this amount, or $344,000. When this amount is subtracted from his net revenues, his income will be $256,000. Dr. Brown is allocated 32.7% of this amount, or $280,933. When this amount is subtracted from her net revenues, her income will be $160,067. Dr. Green is allocated 27.3% of this amount, or $235,067. When this amount is subtracted from his net revenues, his income will be $338,933. As you can see, by using this method, Dr. Green's income is the highest, whereas he was the lowest in the other two scenarios. Again, without a clear understanding of the rationale for this type of expense allocation, Drs. White and Brown may not find this plan as equitable as other plans. These three examples demonstrate how important it is to understand exactly how your compensation will be calculated by a practice that you may be interested in joining. Every practice is unique, and in reality, each practice should have a compensation plan directly tailored to its own makeup and philosophy. Particularly in practices where there is a great variance in physician productivity, it's crucial to determine the factors that will affect your personal compensation. You also need to understand that, as a new physician, you'll be facing a ramp-up period of perhaps a year or more as you build your practice and become a high-level producer for your practice. Much of the important information that you need to make an informed decision about a practice's compensation plan will be contained in the practice management reports. These system-generated reports can be produced with a variety of report parameters. Generally, a monthly report is produced that provides a summary of the type and volume of services performed by the total practice and by each physician. Information typically includes CPT code, volume by code, and gross charges by code. Ask to see these monthly reports for the past 2 years. In particular, you should review the current procedure terminology, CPT reports, and the payer mix report. The CPT code report will list service codes billed by the group and provides information regarding volumes for each physician. This report is a valuable source of data for gross charges and work RVU measures of physician productivity within the group. A payer mix report lists the gross charges, adjustments, and payments to the practice by payer type or payer category. For example, the report may summarize gross charges by categories such as private pay, Medicare, Medicaid, PPO, HMO, etc. Review the payer mix report carefully when you're measuring physician productivity using net revenue or net collections measures. It's important to recognize that because contractual adjustments vary significantly with different payers and payer types, for example between private payers and government payers such as Medicare and Medicaid, a physician's net revenues and net collections will be significantly affected by the physician's payer mix. Generally speaking, private payers and some preferred provider organizations, PPOs, will pay more for the same service than government payers. Many practice management systems provide an income analysis report that provides net revenues or net collections and the expenses of the practice. In addition to the income analysis report, the practice will often utilize an income statement for this information. Some groups produce income statements in-house, and others have income statements produced for the group on a periodic basis by an independent accountant. Either of these reports are necessary to assess the expenses of the group that you'll share in as a member. Now that you have a better understanding of the concepts behind productivity-based compensation, you'll be better prepared to discuss and negotiate your compensation as a physician in many practice settings. Learning to identify and accurately measure the drivers, output, and expenses in productivity-based compensation plans is critical to linking your compensation to your productivity. Ask for and analyze the practice management reports and financial statements. The information they contain will be used in one way or another to measure your productivity and ultimately your compensation. This course introduced common terms used in productivity-based compensation plans, identified key financial and management reports utilized, provided illustrations of some common methodologies for calculating productivity, and provided an opportunity to develop skill in performing calculations used in productivity-based plans. Career Physician's goal, through this course and a number of related courses, articles, and tools, is to provide you with the knowledge and skills you need to succeed as you launch your medical career.